Hey, this is Kyle with KyleSeagraves.com. Today we're talking about conventional loan requirements. So what do you need to get a conventional loan? In a couple other videos I've talked about conventional versus FHA, as well as some of the FHA requirements. And today we're going to talk about conventional requirements. So what down payment do you need? What credit score do you need? What does your income need to look like? And what are some qualifications that the property you're looking to buy needs to have? So right up front, one of the biggest things that people ask is, what's the down payment that I need? So the down payment to get a conventional loan, there's kind of two answers. Mainly, the main guideline that you're going to see with conventional loans, minimum down payment is usually 5% down, okay? Conventional can go down to 3%, but there's a couple more stipulations in there. And those are one of two things. Either number one, you need to be a first-time homebuyer, or at least one person on your loan needs to be a first-time homebuyer to get 3% down, or you can qualify for the Home Ready or the Home Possible loans, but those have an income limit that have actually just recently been shrunk by Fannie Mae and Freddie Mac. So it's kind of a long answer to say what's the minimum down payment. I would expect, or you should expect 5% down, but it can go down to 3%. Again, if someone on the loan is a first-time homebuyer, or if you can qualify for the Home Ready or Home Possible programs. Keep in mind that the Home Ready and Home Possible programs do have income limits, though, that can be difficult to qualify for. So one little strategy in there is maybe you aren't a first-time homebuyer, but let's say someone like your spouse is, or a co-borrower might be. You can use that to your advantage to add somebody else on the loan as a co-borrower to take you from that 5% down requirement down to a 3% requirement by just bringing on one person on the loan who's a first-time homebuyer to qualify for the 3%. So it's a little trick in there. It might not work out because it's difficult sometimes to get people to co-borrow with you unless they're a spouse, but having that first-time homebuyer in there does help you bring down your down payment. Now, the mortgage insurance requirements for conventional loans are that if you're putting less than 20% down, you're going to be required to carry monthly mortgage insurance. So the minute you hit 20% equity in your property, you can get mortgage insurance taken off. But mortgage insurance is there to protect the lender in the event of a default. So it doesn't help you at all. So conventional does let you, give you that lower down payment, that 5% or even 3%, but you're going to make up for, that in opportunity cost with paying some mortgage insurance. And it can be, mortgage insurance can be all over the place depending on your credit score. And that mortgage insurance cost is going to depend on how risky the loan is. So things like FHA loans, those have a fixed mortgage insurance. No matter if what your credit score is, your mortgage insurance is always going to be a specific percentage of the loan. Whereas conventional, it's all risk-based. So that means that if you have a lower credit score on conventional, you're going to pay a lot more in mortgage insurance than somebody with a higher credit score. So that brings us to credit score. What's the credit score requirement on conventional? For most lenders, it's going to be 620. Okay, so you need a 620 to get a conventional loan. Now, what I've found is that if you have a 620, even up to a high sixes, conventional loan might not be the best for you in terms of the rate. Conventional loans are loans that are best suited for higher credit scores, lower debt to income ratio, and higher down payment buyers. And so if you have a credit score within the range of 620, even up to 699, conventional might not have the best rate for you. But if you get past that 700 credit score mark and above, conventional might start showing you better rates and giving you better terms than another government loan could. Also with conventional loans, they can be a lot tighter on their restrictions and credit qualifications. So number one, your debt to income ratio is going to be a lot tighter. So debt to income ratio just means how much monthly debt do you have, monthly debt obligations. So what are your credit card payments, your auto payments, your house payment? Take all of that divided by your income, and that gives you your debt to income ratio. FHA is going to allow you to go up to maybe like a 56% debt to income ratio. Conventional, they're going to lower that. I've never seen it go above 49%. And a lot of times it's going to be even lower than that based on some other risk factors in the loan. So if you have a lot of debt that you're carrying or maybe a lower income, conventional might be trickier to qualify for because they want to see a lot more room in leftover income at the end of the month than other loan programs will. Also, some requirements for conventional loans are if you've had any credit event in the past, you're going to have to wait a lot longer to get a conventional loan than you would a government loan. So for instance, if you've had a bankruptcy, you're going to have to wait a longer period of time on the conventional side than you would on a loan like FHA that's more forgiving on things like bankruptcy and collections. On conventional side, you're going to have to be mindful and ask your mortgage advisor how your bankruptcy or foreclosure, sheriff's sale, collections, any missed payments on your credit report, what those are going to do to your conventional loan, because conventional can be a lot tighter on some of their restrictions there. Also with conventional loans, we run into some property restrictions in terms of, you're going to get an appraisal on the property. Conventional really is pretty light compared to a lot of other loans. FHA loans are really strict on their appraisal standards. FHA loans almost want you to kind of have a move-in ready house, like they don't want any health or safety issues. Conventional is also concerned with health and safety, but not as much as FHA. Conventional loans you can use to buy a foreclosed property. You can use it to buy properties that need to be fixed up. It still needs to be habitable. So keep that in mind with a conventional loan. It still needs to be a habitable home. It can't be so far gone to the point of disrepair that you wouldn't be able to move into the property. But conventional loans are a lot more forgiving in terms of some of the property restrictions. Also, conventional loans, as far as employment, are going to want to see consistent employment. They want to see consistent employment over a period of 2 years, as well as consistent income or increasing income. So if you've had job losses or gaps in employment, talk to your mortgage advisor and find out how long those gaps are, if they need to be explained, and a little bit of how to document some of your employment situation. Just because conventional is concerned about the quality of the buyers that they want in their loan programs. And so they want employment to be consistent, income to be consistent, as well as assets. So what do you have in the bank account? They normally want to see 2 months of your bank statements. And mainly what they're looking for there is, one, do you have the funds to close on the property? Are the funds not borrowed? So they don't want you to get any sort of loan for the down payment. And then are there any large deposits that they need to look out for? Things like money laundering or any sort of fraudulent activity going on in the bank statements. So conventional loans are going to want to look pretty closely at a lot of the employment, income, and asset factors on your loan as well. Overall, conventional loans are fantastic. If you're well qualified as a buyer, conventional is probably the best route for you. It's going to be the most lax in terms of the property requirements, and can give you really great savings compared to other loans that carry heavy mortgage insurance like FHA. And if you're putting 20% down on a conventional loan, you're never going to have any mortgage insurance, which is just extra savings for you. And they really are fantastic loans to get. They can be a little bit more difficult to qualify for than a government loan, but overall, they're fantastic. The requirements are a little bit steeper, but they reward you in the fact that you get more savings and less hassle on the property. So hey, thanks so much for watching this video. If you have additional questions, feel free to leave me a comment below. My contact info is also in the description if you'd like to reach out. I'd love to help you out. Thanks so much for watching.